Earlier today, Symbotic stock jumped nearly 20% on the news that the minnow was swallowing part of the whale. In this case, Symbotic was acquiring Walmart's advanced systems and robotics business, giving Symbotic a mandate to develop, build, and deploy an advanced solution that automates and accelerates its pickup and delivery from hundreds of stores, an order that covers hundreds of Walmart stores. This is a very interesting development. Despite the share price jump over the past year, Symbotic stock is still underwater to the tune of around 25%, which does make me wonder if Symbotic stock is an opportunity for investors. So I'm going to run Symbotic through my investment checklist. This is a very straightforward and simple checklist, and yet it manages to filter out 90% plus of the companies that I look at. So I find this to be a very, straightforward and simple framework that also makes it easier to find things that fit my personal investment journey. I'm personally a big believer in artificial intelligence and robotics. I think it's going to play a huge role in humanity and potentially for investors in the next few years, but I'm still looking for those companies that can pull it off where it sort of fits the checklist. And I say, oh, this is an obvious, this is a no-brainer. This is why I want this to be part of my journey. So I'm curious if Symbotic will fit in terms of that broader perspective, because I know it has to do with AI and robotics. So let's start with this checklist first. Then we'll talk about what exactly they do. When I think about alignment, I got to say it jumps off the page here. You have the founder, chair, president, and CEO controls around 40% of the company. And by the way, hasn't taken salary bonus or stock awards. This speaks to me as an investor. This means to me, you have missionaries out there and you have mercenaries. The mercenaries are the hired guns. That's not Richard Cohn, the founder, CEO of Symbotic. This guy is clearly on a mission to build something, leveraging the cutting edge technologies that they bring to the table, and that ideally, it's helping to transform Walmart and hundreds of their stores. So I do like to see that alignment. Obvious growth. This also seems very favorable, where I see that it's gone from millions in revenue to billions in revenue over the last few years, and Wall Street's expecting them to grow from a little under 2 billion in revenue to nearly 5 billion over the next few years. So this is what I like to see. This is the sort of obvious growth mandate that that is critical for me personally as an investor. So what does Symbotic do? Take a step back. So they are a leader in automation technology, leveraging artificial intelligence vision, leveraging robotics to help reinvent the warehouse. They're working with some of the largest retail, wholesale, and food and beverage companies. They're looking to redefine warehousing. And so they have their Symbots, their robots traveling at speeds up to 25 miles per hour. They have 99% plus fulfillment accuracy and a modular design that can automate and storage and palletizing. So what is I didn't even know what palletizing was until I started doing the research for this video. So this means you take a pallet that might be all wrapped up, then you open it up, and you're having a robot do this, sort it out, send off the items on the pallet where it belongs, and then you might take these individual mixed items and then put it on a new pallet that can be shipped elsewhere. This is very relevant if you have sort of a hub and spoke type of model where you have these large distribution centers that go to other hubs that then get split up. That's then taking the inventory and sending it to the individual stores. You might not need to send a pallet of a certain type of good. It's too much for the store. They don't have the space. So instead you break it up and you have these sort of custom pallets that go to the store on a regular basis. So this is a very interesting development. In other words, it means, taking up less space, moving faster inventory turns, less costs. You're removing a human from the equation, or many people from the equation. If you have familiarity with the Symbotic systems, I'd love to hear your perspective. When we look at the opportunities, they think they're targeting several $100 billion opportunities from in-house, where there's an operator-owned warehouse. They think that's multi-$100 billion opportunity. From a joint venture that's called Greenbox, where they're working with SoftBank. That's a warehouse as a service opportunity, so leveraging their infrastructure as a service. And then they have micro fulfillment. This actually comes to their recent deal with Walmart, where they're buying Walmart's robotics segment. We'll talk about that in just a second. So clearly several multi-$100 billion opportunities that they're targeting. Their goal is to expand from their limited customer base that includes Walmart, Albertsons, to grow their customers, grow the different verticals that they can be, from apparel to consumer goods or auto parts, and then expand geographically. So clearly, a lot of potential for them in the years ahead. Their latest acquisition of this Walmart, robotics assets, this does give them the last mile ability. So that way it really does cover everything from the warehouse to the, individual stores, where you can order something online and then choose to pick it up in the store or have an in-store purchase. So Symbotic is trying to say, hey, we have the infrastructure, whether or not it's a warehouse or a small store, we've got you covered to make it more efficient, which is quite interesting. So, okay, what do I think about Symbotic in terms of the years ahead? Thinking about the valuation, let's keep going through that checklist. As always, this is not financial advice. Also, a quick plug. Earlier this month, Henrik, a premium member, wrote, "Thank you for creating this service. Subscribing to your platform is the best financial decision I've made in my life." That's a direct quote. This follows Michael, another premium member, who wrote, also a direct quote, "So far, the subscription has paid for itself in 3 months. Looking forward to what the future holds." Me too, Michael. I am looking forward to the future. And if you're looking for compelling investment ideas, come check out Unrivaled Investing. When I look at Symbotic, SYM stock, it is important to see revenue growing significantly, as I already called out, from a little under 600 million a couple of years ago to now 1.8 billion, expected to keep growing. The run rate, based on management's guidance for the next quarter, suggests around $2 billion in revenue run rate. We'll see if they deliver that over the next year. The reason why it gets a little tricky is because when you look at their revenue, it's important to parse out what's actually driving it. They have systems, maintenance, and operations. When you're looking at these different revenue line items, just from an investor perspective, generally the systems are one-time in nature. They're going to be low margin, one-time in nature. The high margin revenue businesses are going to be the maintenance and support, the recurring revenue. As an investor, you want the recurring revenue. It gives you more certainty about how a business will do over time, whether or not there's a recession, whether or not customers, change their ordering plans. Oh, maybe business is tough for their customer. They don't want to, update, reformat their warehouse. It's trickier. You're going to have more volatile system sales, whereas maintenance and support should be a lot more stable. The challenge is that looking at this business, a lot of their sales, the vast majority, are systems, meaning it's sort of that one-time in nature, and it's also inherently lower margin. You can see that software and maintenance is much higher margin than their operations and their systems revenue. And so looking at this, you're talking about around low teens gross margin. And when you're talking about low teens gross margin, it's very difficult, just to think about it as a bridge. You have gross margin, and then ultimately profit is going to come after the operating expenses. And so if you have a low teens gross margin, that's sort of a ceiling for where your operating margins could ultimately be. So if you're at low teens, maybe operating margins of single digits, unless they're able to really start, improving their gross margins over time. At this point, it's too early to say, but maybe they could do that in the future. You're also looking at a business that's significantly unprofitable, to the tune of around $100 million in the most recent quarter. That said, they are EBITDA positive, which did surprise me. This is largely due to the fact that there's a lot of share dilution, a lot of stock-based compensation, over $100 million in stock-based compensation. So that is why they're EBITDA positive in the most recent period. Now, I look at this, and this is a deal buster for me personally, which is that from a revenue perspective, looking at the quality of the revenue, they don't really score well on the quality of the revenue. Part of that is because of the systems, but an even bigger part is, yes, it's great to have Walmart as a customer, but it's one thing to be a great customer. It's another thing to dominate their business. And Walmart's around 87% of their revenue in the most recent year. So for me to look at Symbotic and say, it's time for this to become part of my own investment journey, I would need to see a greater diversification, because when you have that level of concentration, nearly 90% of the business, it does mean you have a significant potential blow up risk. You do have the risk that Walmart changes their mind. I think it's equally important to recognize, yes, they're clearly doing well, creating a lot of value for Walmart. Walmart's their biggest customer, and they've been growing with Walmart. But, you should also expect robotics broadly is going to have a revolution over the next few years. AI is clearly going through a revolution. Is it possible that there might be cheaper solutions? Tesla's looking to push their humanoid robot, Optimus. Is it possible that you will have alternative solutions? Yes, it's not specialized for the warehouse, but that you could say, hey, why do I need to get, Symbotic when maybe I'm just going to have a bunch of bots doing the work for me? So you do have that development, which is, customer concentration, where, if they walk away from you in the future, that would create significant pain. And so at this point, this fails my investment checklist because I need to see all of these things in order for me to, really, get excited. But for those types of investors that say, hey, I'm willing to overlook, the revenue concentration. What about compelling valuation? Does it still have a compelling valuation? This is tough. It really depends on what you think about the long-term potential of this business. My view is that I'm sort of anchoring to where their gross margins are today, which is single digits. And so I'm thinking maybe their operating margins are single digits, in the future. Gross margins of I meant to say gross margins of low teens, operating margins of single digits. And so that, it just makes it difficult. Plus, it is difficult to scale this business. Yes, Wall Street's expecting, $5 billion in sales within, let's say, 4 or 5 years. But, that's a lot of one-time system sales. A lot has to go right, for that to happen. I'm assuming around 20 times multiple because of, the uncertainty around system sales, that it's not guaranteed. Yes, they do have this huge backlog that they're going to be working through. So it is important to recognize, they have a $20 billion plus backlog. So that is critical. So, maybe that lowers the uncertainty here. But I'm looking at this and it's valuation is really hard for me unless you're willing to say, I strongly believe that their margins are going to be way higher in the future. The business model is going to sort of transform to much higher margins. As it is today, it's too risky for me, both with the customer concentration and the valuation. Just it's a little too much. I think they're just much easier plays. I've recently called out 2 different companies that I've bought to my subscribers. One is growing around 80% and trading at one-time sales. Contrast with this company, growing, yes, it's growing quite significantly, 50%, but trades at 9-time sales. So there are huge differences. And so I think there are better, cheaper plays out there with more certainty in terms of that obvious growth outlook. Yes, it's favorable, but are you really certain regarding the business model? I hope this video talking about Symbotic is helpful for you. I'm a big believer in that AI and robotics revolution. So if you have some ideas that you think might pass that checklist, I'd love to hear it in the comments below. Thanks so much for watching Unrivaled Investing.